Before going to the first chapter, which is introduction, I would like to introduce myself. My name is AIMAN ANNAJMI FAHMI bin MUHAZIR, and my matrix number is 072527. The first type of financial instrument that will be discussed here is financial liability. Paragraph 11 of MFRS 132 provides a definition for financial liability, which is generally summarized as an contractual obligation for an entity to deliver cash or exchange financial asset. According to the provision contained in paragraph 4.2.1 of the MFRS 9, standard financial liability is generally classified as either a fair value at profit or loss, initially measured at the fair value, and the subsequent measurement, which changes in value resulting in the profit and loss, is to be recorded in income statement, or amortized cost. For classification at fair value and profit or loss, an entity can elect the instrument to be classified as such, provided that the classification of security would reduce the accounting mismatch of inconsistent recognition or measurement. Inconsistent recognition and measurement could also arise if different measurement bases are used to recognize the gains and losses. What is financial equity? Financial equity or equity instrument is simply defined in paragraph 11 of MFRS 132 standard as the contract that result in a residue in the asset of the entity after deducting all its liability. Paragraph 16 of MFRS 132 further discuss the condition that need to be met before an instrument can be classified as an equity instrument. In generally, the instrument must not constitute a contract that requires the issuer company to deliver cash or another financial asset to another entity, or exchanging financial asset or financial liability that will result in an unfavorable condition.
Assalamualaikum and hi everyone, my name is FAIZ bin KASMAN and my matrix number is 072532. Alright, so now I will explain about how to distinguish between liability and equity according to our article. So, liability defines as probable future sacrifice of economic benefits arising from present obligation of a particular entity to transfer assets or provide services to other entities in the future as a result of past transaction or events. Okay, now what is equity? Equity can define as the residual interest in assets of an entity that remains after deducting its liabilities, or from the perspective of a business enterprise that called the ownership interest. In response, Clark 1993 provides a detailed review of the accounting and finance literature on capital structure and concludes that the distinction between liabilities and equity is economically informative and therefore should be maintained. Concurrent with Clark 1993, the American Accounting Association Financial Accounting Standards Committee, known as AAA-FASC, notes that the distinction between liabilities and equity is useful in that it ascribes meaning to income, maintains relative consistency between financial and tax accounting rules, and conveys a distinction between fixed and residual claims. In October 2000, the FASB issued 2 exposure drafts on distinguishing liabilities from equity. The first addresses the liability-equity classification of claims with characteristics of both liabilities and equity, and proposes that claims that impose an obligation to transfer assets or stock be classified as liabilities. The second proposes an amendment to the CON 6 definition of liabilities to include present obligations that require the issuer to transfer a fixed dollar amount of shares of its own stock.
In financial reporting, distinguishing liabilities from equity can be a complex and challenging task. This is because liabilities and equity are both forms of financing for a company, but they have a different characteristic and implication. For the financial statement, liabilities refer to the obligation that a company owes to its creditor, such as loan, bond, and account payable. This obligation must be repaid at a specific date in the future and considered as a source of financing for the company. On the other hand, equity represents the residual interest in the asset of a company after liabilities are released include capital stock, retained earnings, and reserve. Equity also considered as source of financing for the company. So one of the main problems in distinguishing liabilities from the equity is the existence of certain financial instruments that have characteristics of both liabilities and equity. Examples of these include convertible bonds, preferred stock, and options. These instruments can be difficult to classify because they have characteristics of both liabilities and equity, and their classification can have a significant impact on the financial statement. So problem that the accounting profession has faced in distinguishing liabilities from equity is the possibility of difficulty and error in distinguishing credited interest from owner interest. The problem of this issue arises when there is potential for confusion and inconsistent application among accounting professionals and companies.
Solution. The financial statement perceives the difference between the firm more clearly, which is one of the key characteristics of the uncapital approach. There are 4 financial reporting adjustments under uncapital approach compared to the current approach. First, because it only includes the whole sum of money the company has made from selling goods and services, the book value of equity as defined by the uncapital approach reflects a measure of the firm net worth rather than a measure of the owner net worth in the company. The uncapital approach book value of equity, which only incorporate money made from selling product and services, is a better indicator of the company capacity to live up to the expectation of its claimant. Second, net income, as defined by an uncapital approach, is a measure of the firm income rather than the income of the owner. Income distributed to owner reduce net income under the uncapital approach and is excluded from net income under current approach. Third, under the uncapital approach, financial statement are calculation, which refer to how financial statement variable on one financial statement mathematically related to those on the financial statement is easier to observe between the balance sheet and income statement of comprehensive income. According to a current approach, net income is equal to the net change in retained earnings plus distribution to shareholder, whereas comprehensive income is equal to the net change in equity over the course of the period net payment to shareholder. Therefore, under the uncapital approach, net income is just equal to the charge in retained earnings during the period, and comprehensive income is simply equal to the charge in equity during the period. Last but not least, the uncapital approach constantly unifies the display of financial statement across the balance sheet, income statement, and statement of cash flow. The balance sheet is using the uncapital approach specifically separate the accumulation of capital received from issuing of claim and accumulation of capital received in the sale of goods or services. The statement of cash flow separate cash received in the sale of goods and services into separate category from cash received in the issuance of claimant. In the similar manner, the income statement show amount earned in the sale of goods and services, but does not include amount received from the issue.
Even though the uncapital approach has been implemented, it still has its flaw if it's implemented without clear guidelines or widespread acceptance of this alternative approach. This is because the proposed approach involves using a more subjective and qualitative approach to determining whether an instrument should be classified as a liability or equity. There also may be confusion and inconsistent application among accounting professionals and companies, leading to potential error and misinterpretation in financial statement. Additionally, this confusion and inconsistent application may also lead to difficulties in comparing the financial statement of different companies, making it harder for investors and analysts to make informed decisions because of lack of clear and specific criteria for determining the classification of an instrument.
In the view of the current dispute among the accounting profession of how to identify liability from equity, we provide the earned capital approach as an alternate method for separating liability from equity. The earned capital approach is based on distinction between capital acquired from issuance of claims and capital earned from selling goods and services. In contrast to the current financial reporting standard, which distinguish between the interests of a firm, creditors, and those of its owner. The earned capital approach distinguish between capital acquired from the issuance of claim, for example, external capital, and capital earned from selling goods and services, for example, earned capital. In particular, this approach, liability equity consideration method, classifies external capital as liability and earned capital as equity. The earned capital approach represents a fundamental shift from the current financial reporting model, which report information from the perspective of a firm, so-called owner, to a new financial reporting model that reflects the notion that a firm is an entity distinct and separate from its so-called owner. We acknowledge that for some, the emphasizing the idea of ownership in financial reporting is a dramatic shift from existing approach. Nevertheless, we believe this deviation is necessary if the accounting provision is to reach a satisfying resolution on the question of differentiate liabilities from equities. Any models of financial reporting in which the liability equity difference is based on the idea of ownership would inevitably struggle to differentiate between the owner and creditor interest. So, that's all from us. Hope you guys understand what we want to deliver. Thank you for watching.